one of the things that you and I talked about when we first started was what's a futures contract? And, you know, I think we're going to run through the definition. Then I think what I'd love to do is to hear, your thoughts in terms of what you perceived it and how we can make this a little bit easier. So, and this is what always, it's so funny. I started my career like you, trading, and then moved to the education side of the CME. And I'd always start with a slide like this, and I found that you tend to pull people away than bring them in when you talk about this legal or this very static definition that a futures contract is a legal agreement to buy or sell a particular asset at a predetermined price at a specific date in the future. Now, legal agreement, particular asset, specified date, that all becomes, all right, these are different than what I'm used to trade, whether or not I'm an equity trader or even an options trader. And I think, Jermal, I'm curious because one of the things they did so well when they built options on equities was they made everything equivalent. And they made the size of the contract equivalent, the dates equivalent, what you were doing, and the difference between this legal agreement and the construct in the options world. And, I think this is really the piece here. The buyer of a futures contract is obligated to buy the underlying asset at a specific quantity at the specified date when the contract expires, vice versa for the seller. Let's not worry about that now, but let's talk a little bit about the world you live in and the world we're coming to and what your questions are about this basic core concept about what's a future.
Yeah. And let's back up a slide. Because it is interesting. You're right. We always start, I remember early in my education of options, there's always this juxtapose of options and futures. They always talk about it in that way. You just talk about this idea of, an obligation from what I remember versus, how in options sometimes you have rights and you sometimes have obligations, right? So it's funny because when, in looking at this, you're right. It's almost like we should have those terms sort of light up. Legal, ding, predetermined, ding, those are the things that sort of throw you off. But I'm guessing the legal portion comes from the fact of it would just be willy-nilly if people didn't have this type of obligation, right? Like you could put this on and whatever, and this gets to and correct me if I'm wrong. Futures contracts are generally guaranteed by the CFTC, right?
Futures contracts, and it's a great question. They're regulated by the CFTC.
Regulated. Okay.
The way the options world is regulated by the SEC. So different regulatory bodies. The contracts are guaranteed, or the performance. One of the great things I think you love from your world and I do in mine is this transparent order book that we know we all get treated the same way in the same fashion, and that our trades are guaranteed. And what we mean by that, and I love the fact you mentioned that, is because if I go into small 75 and I buy a contract and you happen to be the seller, I'm not buying it from you. I'm buying it from the exchange and you're selling it to the exchange. And what I mean by that is they guarantee that when I buy it, you're going to be good on the other side. Same way they're guaranteeing that you're going to be good if I don't perform. So we talk about this legal piece. The legal piece is taken care of by the exchange, by this guaranteeing entity. And that's a really important piece you hit on.
Yeah. Yeah. And that's the thing that I think we always end up thinking about. And then the other thing you said about I don't think you said standardized, but the idea of everything is 100 with options, right? And that's a little bit different when it comes to futures. And honestly, I think that's one of the things that's a little bit daunting at times. I remember we would, when you are trading certain futures, you're thinking about those multiples or what trades what. So, I think having that in mind as well is something that, can be a little bit intimidating. When I say intimidating, it's one of those like, oh, well, I'm just not going to trade it since I don't understand it. And that's why this is so important, because we can get that understanding and not only for myself, but in everybody who's watching, they can understand more, of these things that we talk about. So then it becomes, like natural after a while.
Yeah, absolutely. And, you're right. So particular size, a particular quantity of the asset, it is different. And that's played through or exhibited through the multiplier of whatever you take the price and multiply by it. That's what you're controlling. You always know in the world of options, it's 100 shares times the price, whether it's Amazon, Google, or USO, which is great. A little bit different in the futures world. The good news is once you learn that size, and this is where you talk about a specific contract and its size, it never changes. The good point in all these specific pieces of it, the only thing that changes is price. Same way it does in the equities and the equity options world. The one thing you want to move is price, and that's the one thing that does.
Okay. Yeah, we can move forward. For everybody who's watching, this is fantastic. I'm fine. Like, for all of you out there who wanted to be the student that asked the teacher the questions the whole time, that's what's happening right here. This is great. So, while we're here and while we're discussing this, what's the, the idea of a forward versus a futures contract? What's the deal there?
Okay. You know what? A forward contract. So a futures contract and a forward contract, by inference, they both speak to a price of some product sometime in the future. Now, the difference is that a futures contract is that standardized contract we talked about. It's the same quantity for delivery at the same date for everyone. Everyone trades the exact same size and date for that particular product. A forward contract is determining the price of a product in the future, but it's usually a bilateral non-exchange agreement. So what that means is I'll pick up a phone, Jermal, I'll call you and say, hey, I've got 2,200 bushels of wheat I need to sell in 38 days. And you will create a price and we'll agree to that price and we'll book it. Now, it's a very bespoke or proprietary agreement that if either one of us were wanting to get out of that deal and trying to find someone else to take it, they'd have to be willing to accept all those particular nuances of that forward contract because it's very customized. So it's not what we call fungible. I can't go and just sell it to someone else in a very liquid marketplace. So
you're going to excite people with that word fungible these days.
Yeah. And you know what? Fungible just means what I buy, you're willing to buy. And everybody in the same marketplace, we're just trading contracts that are fungible, which means I can exchange them back and forth in a very simple and easy way. So that's a little bit to speak of why forwards give you that same type of price discovery, but it's not the world we live in. We want to live in the world where not everybody could trade for democratization's sake, but selfishly for our sake. That way there's liquidity.
Yeah. And so, again, and I think it seems from what little I do know, I think we have it laid out here. Well, having that word obligated highlighted, I mean, that's the biggest part here, right? Like, doesn't matter whether you bought it or sold it, you're obligated to do something at the end of the day. And this is of course, kind of like in options, right? Like we take everything to expiration in a way. This obligation is really about expiration, right? Like you can buy and sell out at any given time, but the obligation is really about expiration, so that everybody really understands that, correct?
And you're exactly right, Jermal. And that is where, so at the end of the contract period, or when the futures contract expires, depending on the contract, you're obligated to either make or take delivery. Now, the good news is in our world, holistically in the whole world, less than 2% of all futures contracts actually go to delivery. And the people that are doing that are actually people who live in the physical world of crude oil or grains or any of the other products. All small exchange products are cash settled. So when they expire, the obligation is just to either collect the money that you've made or make sure that you have the capital in your account to satisfy that obligation. And that's as simple as it is. So you're right. The right and the obligation are two different terms between your world and the world of futures you're coming into. But it really is because I always get asked that question of, well, where do they drop the 1,000 barrels of oil or the 5,000 bushels of corn? And it really is not ever a practical or an actual thing that any of us are going to be put into.
Yeah. Yeah. I think we can move forward. It's good that we had that at the bottom for now to not worry about assets and all that, because I can't wait to hear the stories later down the line of the biggest thing that you've had to take delivery on. I can't wait. And we'll talk about that another time. But delivery was always what we called the idiot tax, and we'll talk about the idiot tax at a different point.
So if you're obligated to buy the asset at the price of the futures contract on some date in the future, then you want the price to move higher between now and that date. And here's what I love is that futures are binary outcomes. So they simplify the process of gaining exposure. And all you're looking for is that markets trade higher and lower between the time you put it on and the time you take it off.
Mm-hmm. Yeah, this is the part where I start to feel silly as to why I've never traded them because it's like, it's so simple. Like this is the simple part, right? I mean,
right. And you know what? It clears the clutter. And what I mean by that is, one of the great things you're going to find is pure price exposure. And, that sounds so simple and actually not even really relevant. What does that mean? Well, if you're trading gold futures, you're not trading a miner that has so many other things involved in it that make it look and feel like an equity. So some days it moves like metals, some days it doesn't. Here you're getting pure price exposure. If we can remove the complexity and remove as you highlighted, all those different moving pieces, depending on the product you're trading, the pure price exposure, I would think with that binary outcome of I think we've also felt this, and I'm sure you have when volatility expanded or contracted in the options world, is having the right assumption and having the market not move in the manner or fashion the assumption was based on.
Yeah, I think, what you said was really poignant there, this idea of you're trading, a gold miner stock and it has all these different things going on with it versus the idea of just pure price exposure when you're talking about a future. Now, I mean, of course, there are different things you watch for, right? And there's different things you pay attention to depending on the asset we're talking about. But it seems to be a little less cluttered. And I think that's the draw, with futures. I mean, it's a lot less cluttered than it is with a stock. I mean, we saw some complicated stuff happen in a couple of stocks more recently.
Right.
It's just, it's a different ball game. It's a different ball game. So I think this is what makes futures really simple and interesting to people like myself and others.
I think and you're spot on there. And that's what we're trying to get rid of the clutter, because I think what we all want to do is we all have an assumption, especially, someone who's traded professionally like you have a lot of assumptions going on in the marketplace. It's how do I simply express them in the most efficient manner possible? And that's what, at the end of the day, that's all we're getting you to do. We're getting you to, I'm a hammer dude. All I want to do is use my hammer. And this is, I don't want any of the complexity of the other pieces of the toolbox. I just want to express that opinion without any of the baggage that you mentioned. And a futures contract with that complex standardization piece that we talked about, standard and forward date and all these other pieces, when you take all that away and realize it isn't relevant to what we're going to do, it's a very simple way to gain exposure. And we'll talk about, that's exposure in terms of the rest of the world and the efficiency of futures. So really, this was a great first piece. And Jermal, thank you so much for, spending the time to walk through us, because your questions will really drive our story as we move forward here. And I think they're going to drive everyone's story as we move forward and get everyone comfortable into the world of futures.